All right, so one of the most confusing things as a buyer is being able to figure out what all the things on the estimate mean. There's a lot of items you've never seen before. And even if you have seen one before, this will refresh you since I doubt you remember all these things the second time around. So I'm going to teach you how to read this estimate sheet. Now, it can be called an estimate, a good faith estimate, closing cost worksheet. It can be called a few different things, all meaning the same thing. This is what you see before you go under contract on a house. Now, before I start through this, not all of these estimates will have all the same items on them. Sometimes I won't even give this template and it will read a little different. And also you'll see on the top right corner here, there's reference to what's called a loan estimate. You get that once you go under contract, and then a closing disclosure you receive a few business days before closing. The loan estimate you get once you go under contract, and that closing disclosure will also have different layouts than this. But if you can read this, then you'll be able to understand the loan estimate and closing disclosure. But anyways, let's start with the top, the closing costs. And I'll have a deeper breakdown of these 4 different types of closing costs later on my site if they're not up already. And that'll give you an even better explanation of the purposes of these individual costs than what I'll give you here. Okay, so just remember, these closing costs are all decided by different entities. Okay, we set ours, then the appraiser, title company, and government set their closing fees independently of us. All right, we do not influence the title company appraisers and government's closing fees and vice versa. The only set of fees that you can really shop is ours and the title companies, but they're going to be just about the same as other lenders and title companies anyways. So let's start at the top here. The appraisal. So this is the first set. This is the appraiser's fee. They determine this. On here, it's about $690. It can run you anywhere from $500 to usually $700 is a typical appraisal. Then the second set of fees, you can see from the credit report fee all the way down to the tax service fee. These are the lender fees, okay? So the lender's going to have a main fee. It's going to be the underwriting fee right here on this estimate. Can be called other things. It can be called the processing fee, or some other just type of lender fee. This is the biggest one we have here. It's $11.95. That's the bulk. That's to pay all the people on staff here behind the scenes that help get your loan to closing, keep the lights on, so on and so forth. And then you'll see here there's these other third-party fees that we pass on to you that we have to pay out in order to get your loan closed. So there's a credit report fee here of $80. We got to pay the credit bureaus money to be able to use their credit reports that they have on file for you to determine what loan we can give you. Then you see these 3 here, the flood cert, IRS transcript, and VOE fee. We also have to pay a little bit of money either to dig into a database or to verify that you've paid your taxes recently and still are at work. And then last lender fee here is this tax service fee. It's $80 or $68 here. That is to basically cover the underwriting fee that we pass on to you. So that's the lender fees. Next set of fees here is the title company's fees. This is usually the most expensive set of fees. It runs from the examination all the way down to the binder here. The main title fees are going to be the title insurance. You pay one for insuring the lender and then one to insure yourself. And then you pay some other pretty much set like processing fees here. These title companies, they all write them up differently from shop to shop. But there's going to be a fee for them to do a title search on you, which here is called the examination. There's going to be a settlement service fee. That's for the lawyer on closing day to just run you through all the paperwork. And there's going to be several other items here, all regarding to processing or just getting you sets of documents after closing. And again, I'll have a better breakdown of this on the title fees video. But that's the title fees. Then the next one is The government fees takes you from recording deed here all the way down to state transfer taxes. So there's 2 recording fees here. Those are just to pay for the labor manpower hours that it takes down at the county courthouse to record these documents with the state and the county. And then the county is going to charge a deed fee to you, and they're going to charge a mortgage fee to you. So the deed is for actually purchasing ownership in the house, and the mortgage fee is obviously to get a mortgage. And then the state's going to do that on their end. Uncle Sam's always going to take a piece of the pie. This is impossible to avoid. That is the second biggest set of fees out of the 4 different entities, is from the government usually. And here, this is Fairfax County, Virginia. This is costing you about 0.6% of the purchase price in government fees here. You'll see that the total approximate cost of closing fees is $9,192, and that's on a home price of $500,000. So that's just under 2%. That's pretty typical of what you see. So that's that. That's the closing fees. Now we also have to take into account the prepaid interest and taxes and insurance. Here it's written as prepaid interest and escrow/reserves. This top fee here is prepaid interest. It is listed at, 15 days. It's $60 a day. And that is put on there because when you pay for the mortgage, you're paying this in arrears. So let's say you close on your new purchased home July 16th in this case. I think it would be July 16th. That would mean 15 days are left in the month. So we got to collect interest for the remaining half of that month before the first of the month of the next month. Because what happens is, since this is paid in arrears, we don't collect money from you at the start of the month before you actually go on to live in the house. So you're not going to make a payment August 1st if you settle on July 15th. Your first payment isn't going to be until actually September 1st. And on September 1st, you're going to pay for all the interest that accrued in the home in the prior month, which is August. So on that first payment, you're not paying for any interest that accrued on the home in July when you technically own this house for 15 days. So that's why we collect this prepaid interest for 15 days up front, costing you $900. Now, that amount of money that you pay in prepaid interest is going to be based on the amount of days that are left in that month that you close in. So if you close early in the month, it'll be a bigger figure. If you close late in the month, there's only a couple days left, and that prepaid interest amount will not be very big. Now, prepaid insurance, next part. So when you close on your home, you have to be insured. I'll talk to you more about that in the insurance episode as to why. But on closing day, you're going to have to bring one entire year's worth of money to cover yourself on that home to make sure that home is insured for an entire year. So that's why we're collecting 1080 of hazard insurance on this account. Because I'm going to estimate the homeowner's insurance as being $90 a month. 90 times 12 is 1080. So on closing day, you are bringing enough money for the title company to then send to the homeowner's insurer. It could be State Farm or whoever, so that you're insured and good to go. And then we also have to collect a couple months from you up front to go into your escrow account. So we collect 2 months from you, $180 there, so you have a little cushion. And then you have your county property taxes below. You're paying several months of that up front as well. This is putting here roughly 6 months, so that the next time county property taxes are due, we will pay your county on your behalf. Now, this whole escrow account, you have to set this up if you don't have a 20% down payment. If you have 20% or more, you can usually waive that. Even the people that do those 20% or more down payments, they usually don't want to waive that anyways, because it's just a lot easier and more convenient to pay your lender a little bit a month to cover your tax and insurance amount, and then just have us pay them, when that's due every 6 months for the property taxes and 12 months for the hazard insurance. So this county property tax prepayment will also be based on the number of days in the house that you're going to be living in before the next set of 6 months worth of property taxes are due. So let's say and this is on this high side, this $24.99. That's like a full 6 months for this scenario. So let's say you moved into the house, and then property taxes are due in 3 months. So the seller will actually, on the closing disclosure, they'll be held responsible to have to pay for 3 months worth of property taxes, because again, they're collected every 3 months, and if they were paid for by the seller 3 months ago, by the time you purchase the house, they will bring that amount of money, so that when the next set is due, then you will pay your proper amount that you owe the county, because you weren't living in the house for 6 months. You were only living in it for 3 months. So this former owner brings a little money for that on closing day. So here we have 6 months. It could be 2 months that you're bringing. It could be 6. It could be 8. We don't know. It depends on what time of the year that you close in. So here, 6 months means 3 months for cushion in your escrow account, and then 3 months for what's going to be due next time these property taxes are due. But ask me about that. That's a big question mark there for a lot of people if I didn't explain it properly, clearly. That's the escrow account. We collect a little every month so that when those are due, we pay those for you. And we do collect the cushion because sometimes people pay late, and then those numbers do adjust and increase over time with inflation. So we don't want to have to pay out and then be caught with our pants down and not being able to pay the insurance company or the property taxes to the county when those are due, or else we're in trouble. Now, scroll down to the bottom here. A lot of this stuff is kind of second nature, or not second nature, but pretty self-explanatory, but I'll tell you what it all means anyways. So here you got the purchase price of $500K. If you paid in earnest money up front on closing day, then that will be factored into your final cash to close, and that would be listed right there, so that on closing day you wouldn't have to bring that money again. It would already be subtracted out of what you then owe on closing day. The loan amount here is $400,000. Sometimes there's a second loan that goes behind that would be listed here next. Sometimes the seller pays closing costs. They give you a subsidy that's negotiated with the agents before going under contract, and that money would be taken into account here, and then it would detract from your amount of cash that you need to bring to closing. The next part here, sometimes on the VA loans, the FHA loans, there's a funding fee that you can choose to pay up front or lump it into the loan. And then if you don't put 20% down, there's always the upfront mortgage insurance that you can choose to pay up front. I don't recommend it, as you've seen me say in other videos, but that would go here. And then this $91.92 is your total closing costs paid by you. Next figure, $44.84, is the prepaids. And then paid outside of closing fees paid by the borrower. This is things that you don't pay on closing day, like the appraisal is paid up front. So that would then be taken out of your total approximate funds needed to close on the closing disclosure. So then on the right is your interest rate. Pretty self-explanatory there. Your APR. Your APR is basically, it's a hypothetical term, really. It is your interest rate plus pretty much all these closing fees if they were going to be spread out over the term of the loan, which in this case is 30 years. So it would kind of be like the interest rate plus those closing costs spread out to give you then a new interest rate. That's the total cost of borrowing. That's the interest rate plus the closing costs, really. To round out the total monthly payment, you got the principal and interest. The second loan, if any, the real estate taxes per month that we'll collect from you at the start, your monthly homeowners insurance, monthly homeowners association listed here if there is one. Now, the HOA fee or the condo fee, we're not going to collect that from you every month. That's going to be paid to them separately. But we still list it on here just so you know for budgeting purposes really how much this house is going to cost. And then if there's mortgage insurance paid every month, that would be listed here. And then we've got another spot that could be for, I don't know, any other miscellaneous item that I'm forgetting. But then this shows your total approximate monthly payment at $2,852. So that's how you read an estimate. I hope that made sense. If you have questions, please call me, text me. I think you got my email, cell phone by now. Please engage with me. I want to help. And that's that. Thank you.